If you own a business and you sell it, the federal capital gains tax rate on your profit is 23.8%. And that's before the state takes a cut. On a $2 million gain, that's over $500,000 going straight to the IRS in the year the deal closes. Here's what most business owners find out after the fact. The tax code has at least 3 legal strategies specifically designed to reduce, defer, or in some cases, completely eliminate that bill. Most business owners either don't know they exist or they find out about them 6 months after the sale has already closed, when it's too late to use any of them. So in today's video, I'm going to walk you through all 3. The first is an installment sale, a way to structure the deal so more of your gain gets taxed at lower tax rates instead of all piling into one brutal tax year. The second is an opportunity zone investment, which lets you defer your capital gains bill and potentially eliminate the tax on any new growth entirely. And the third is something called qualified small business stock, section 1202 of the tax code, which, if your business qualifies and the timing works, you can exclude federal capital gains tax on up to $10 million of gains completely. By the end of this video, you'll know which one of these tools might be available to you and whether you still have time to use them. Let's start with installment sales, because this one is the most broadly applicable and the most misunderstood. Here's the assumption most business owners operate on. When you sell, you get the money and you pay capital gains tax on the profit in the year the deal closes. That's true if you take a lump sum, but it's not required by the tax code. An installment sale is when you structure the deal so the buyer pays you over multiple years instead of all at once. Under the installment sale rule, you only recognize the gain in the year you actually receive each payment. You don't owe tax on money you haven't collected yet. Here's what the math looks like. Say you sell your business for $3 million. Your cost basis is $500,000, so your taxable capital gain is $2.5 million. If you take that as a lump sum in the year it's sold, you recognize $2.5 million of capital gains in a single tax year. On $2.5 million gain, your federal tax bill comes in somewhere around $550,000. Now, change just one thing. You structure this as a 5-year installment sale. The buyer pays you $600,000 a year. That's principal plus interest. And you recognize $500,000 of capital gains per year instead of $2.5 million all at once. At $500,000 of annual gains, you're in the 15% long-term capital gains rate and not the 20%, plus the 3.8% net investment income tax. Your federal tax on each payment comes in around $84,500. Over 5 years, that's roughly around $422,000 versus $550,000 in the lump sum sale scenario. That's $130,000 in tax savings without doing anything complicated, just changing when you recognize the income. Now, there are real limitations here you need to know. The buyer has to agree to the structure. Private equity buyers typically want a clean cash close. They're not interested in becoming your creditor for 5 years. Installment sales tend to work best with individual buyers, a business partner, a key employee, a family member, or a motivated buyer who needs the flexibility. That's a reality in a lot of business transactions, which makes this one worth understanding. Second, the interest the buyer pays you on the note is treated as ordinary income, not capital gains. So you owe ordinary income tax on that piece. And third, if you have depreciated recapture on business assets, that portion has to be recognized in the year of the sale, regardless of the installment structure. So it's not a clean sweep on every dollar. But for the right deal structure, this is the most straightforward capital gains reduction tool available to any business owner, and most of them never think to ask about it. Now, let's talk about opportunity zone investments, because this one gets pitched a lot and it also gets misrepresented a lot. Let me show you what it actually does. Anytime you have a capital gain from a business sale, from real estate, from anything, you have 180 days to invest that gain into a qualified opportunity fund. When you do, 2 things happen. First, you defer paying the capital gains tax on that original gain. The tax liability isn't gone, but you've pushed it out. For investments made under the original program, meaning before the end of 2026, that deferred gain becomes taxable on December 31st, 2026. For investments made after that, Congress permanently extended the program in 2025, and the mechanics shift to a rolling 5-year deferral tied to when you invest rather than a fixed calendar date. Second, and this is the part that actually matters, if you hold the Opportunity Zone investment for at least 10 years, any new appreciation generated inside the fund becomes completely tax-free at the federal level. Here's what that looks like. You sell your business and recognize a $1.5 million capital gain. You invest that $1.5 million into a qualified opportunity fund within 180 days. You owe zero capital gain tax today. You hold the investment for 10 years. The fund performs well. Let's say it grows to $3 million. When you exit, you owe tax on the original $1.5 million gain from the business sale. That deferred bill is now due. But the new $1.5 million of appreciation inside the fund, zero federal capital gains tax. That new growth is completely excluded. Now here's where I'm going to be straight with you, because the way this gets pitched sometimes glosses over the part that actually determines whether it works. An Opportunity Zone fund is an investment in a real estate development or business activity inside a designated low-income census tracts. You don't control it the way you control your own business. You're handing money to a fund manager, deploying it into a specific project in specific geographic areas. The quality of the fund matters enormously. If the development project stalls, if the market in that zone doesn't appreciate, you've deferred your tax bill and gotten a mediocre return at best. That's a worse outcome than just paying the tax and reinvesting the after-tax proceeds into something you're confident in. So the question to ask isn't, can I defer my capital gains? The question is this specific Opportunity Zone fund a generally good investment independent of the tax benefit? If the answer is yes, the tax benefit on the new gains makes it even better. If the answer is no, the tax deferral alone doesn't justify the risk. Now, here's the one that surprises people the most, because the numbers sound too good to be true until you understand how it actually works. It's called Qualified Small Business Stock, Section 1202 of the Tax Code. Here's what it says. If you founded or invested in a C corporation that meets certain criteria, and you've held that stock for at least 5 years, you can exclude 100% of your capital gains from federal income tax, up to $10 million of gain, or 10 times your original cost basis in the stock, whichever is greater. Now, there are 4 qualifications, and all 4 have to be true, not just some of them. First, the business must be a C corporation, not an S corp, not an LLC, taxed as a sole proprietorship or partnership. If your business is currently an S corp or an LLC and you want to use this provision, you need to restructure. And the 5-year holding period clock starts from when you acquire stock in the C corp, not from when you first formed the original business. Second, you must have acquired the stock at original issuance. You can't buy shares on a secondary market and qualify. You have to have been a founder or an investor who put in capital when the company was originally issuing those shares. Third, when you acquire the stock, the company's aggregate gross assets had to be $50 million or less. This provision was designed for small businesses with early stage companies, not large established firms. And fourth, the business has to operate in a qualified trade or business. There's a specific list of excluded industries, such as health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services. If you're a general contractor, a specialty subcontractor, a manufacturer, a technology company, or most other business types, you likely qualify. If you're in one of those excluded categories, you don't. Now, state taxes are a separate conversation. And this is a real limitation worth knowing. Some states conform to the federal exclusions and some don't. California, for example, does not recognize Section 1202 and would still tax the full gain at the state level. So, state matters. But on the federal level, the exclusion is real, it's available, and it's not being used anywhere near as often as it should be. I know what you're thinking. If this provision exists, why doesn't everyone use it? Here's the catch. You can't restructure into a C Corp right before you sell and have the 5-year clock start earlier. The holding period is a hard requirement. This provision only helps if you plan for it before the gain was already sitting in front of you. For business owners who are 2 or 3 years into building a qualifying company and are already thinking about the eventual sale, structuring as a C Corp from the start and holding qualified small business stock is one of the most powerful tax planning moves they can make. To be clear, these 3 strategies aren't interchangeable, and not everyone applies to every business owner. Installment sales work best when you have flexibility in how the deal gets structured and a buyer who's open to receiving payments over time. It's a bracket management tool. It doesn't eliminate the tax, it spreads it across years so more of it gets taxed at lower rates. Opportunity zones work best when you have a meaningful capital gain you'd rather not pay tax on immediately, and you're looking for a legitimate alternative investment with real return potential. The tax deferral is a secondary benefit. A good investment is the primary one. And the QSBS exclusion under Section 1202 is by far the most powerful of the 3, but it requires the most planning lead time, 5 years minimum, the right entity structure from the start, and a business that operates in a qualifying industry. If you own a business and you're within a few years of a potential exit, or if you're already in conversations with buyers and wondering whether any of these strategies still apply in your situation, schedule a free intro call. The link is in the description. We'll look at your business structure, the timeline you're working with, and the approximate size of the gain you're looking at. And I'll tell you straight, which of these tools are actually on the table for you and which ones aren't. No commitment, just a clear picture of where you stand before the deal closes.